Welcome, everybody. This is our 12th Alpha Talk. Thanks for joining us today. Phillip Colmar here. Thanks for joining, and we're really interested to hear about your thoughts.
Thank you for having me.
Phillip, let me tell you a little bit how we usually speak with people, with economists from different backgrounds, different countries, and the first thing that we like to know is a little bit more about them, about how people do economics in different countries. So, Phillip, you have been doing research probably for 20 years, no? And I think I'd actually know a little bit more about what you do in MRB Partners. What makes you different? I can make an introduction myself. I have seen your research; it's really amazing. But maybe if you can tell me a little bit about you, about your background, have you reached this your value proposition?
Okay. Yeah, so as a quick background, yeah, I came after academia, which was certainly economics and finance both at the undergrad and graduate level. I joined a firm in Montreal, BCA Research, the bank credit analyst, another independent macro space. Was there about 8 years. Developed into probably the fastest emerging strategist there, and ended up taking over a lot of or doing global macro. Global multi-asset. So I covered pretty much every asset class. After about 8 years, myself and some partners broke off and we formed MRB Partners. So MRB Partners was originated in 2010. And the goal there is BCA, for those who knew it. It got bought out by a private equity firm and was became a silo approach. And so we wanted to pull it back into, instead of silos where there was bulls and bears on just about every topic and everybody was working independently, back into a one house view, one cohesive strategy, cover global multi-asset strategy, whether that be asset allocation or absolute return strategies, but on a global basis as one team. So without the inconsistency, so to speak. That was a lot of the pushback we had during the pandemic, obviously, bulls and bears. Sorry, not during the pandemic, it was the Great Recession at that point, the housing fallout. And so anyways, it opened a space in the market for us, was something that we wanted to achieve. At the same time, MRB was formed to do investment strategy first and foremost. So economics and top-down is the way that we call investment strategy on a global multi-asset basis. Whereas the spectrum of market research, or certainly economic research, has a wide spectrum, and even at our previous shop there were many people who view their role to be adding commentary or kind of insights on hot issues, be provocative, so to speak. Our goal here isn't so much that. Our goal here is to set ourselves up almost like an asset management firm, call the markets, tell our clients, which are the biggest behemoth asset managers on the planet, pretty much. We have a wide spectrum of clients, but we started off with some of the behemoths, but help allocate where they should put an allocation of capital and outperform the markets. And secondly, be provocative. Now, of course, if you're good at the first one, you periodically have to lean against the consensus, and you can be provocative anyway. So I don't think that the two are isolated, but that was the goal for us. We broke off with a bunch of like-minded people. We put together a whole bunch of other strategists from different shops, and formed that. In terms of how we do research here, it's there's a spectrum there too. There's the quantitative. I started off as a quant, and I like that because it has rigor to the analysis. The problem is it also has rigidity to the analysis in many ways, and you have to have past data to sort of validate it. So it comes to a problem when you're dealing with a structural shift or a crisis or something that we haven't seen before. And fortunately, I was able to pivot from that with the current group that I'm working with, and I formed this business with before the crisis, or before the financial crisis, so that we wouldn't get our head handed to us by building all our quant indicators blowing up. But the other side of the spectrum is qualitative, and it gets a reputation for swinging from the hip. And so although it adds a lot of flexibility, it lacks rigor. So where we found our sweet spot was framework analysis. So that is what our expertise is. Our frameworks cut across countries, so it puts the global picture into scale. So we may have strategists that work on, say, LATAM or US equities or whatever it may be, but it will be in a global context. And it's also in a cross-asset context, because debt markets influence equity markets and vice versa. Currencies obviously have an impact. So our frameworks incorporate that. And so collectively as a team, we put together that. My role is a global multi-asset strategist. So I sort of sit in the big picture sphere, if you will, when we have a lot of subject matter expertise that focus on different regions.
Okay, can we deep dive a little bit on the framework analysis? What you mean by that? You mean you got a global model and you connect the dots between the countries, or basically you discuss as a team and you build a global view on that, and you do a top down on every country?
Yeah, we're pretty good at framing an issue to start with. And we have core frameworks that underline it, whether that be looking at an asset market and how we'll go and what weights we'll sort of put into an asset market, whether, if it's equities, it would be earnings trends and how we incorporate valuations and technicals into the backdrop of it, but what drives those earnings trends. But on a global basis, yeah, I mean, a simple approach would be there's quite a few comprehensive ones. But if we take the global economy, for example, a simple approach would be is that you can't look at the world in an isolated. That's the problem with too many, markets don't work that way, but strategists do. They might be US centric or European centric or even China centric, but they tend not to put them all together. And unfortunately, even though the US may be the biggest country in the world, it's still only, a quarter of global GDP. So it doesn't skew the whole thing. So even if you want to be simple, you would have to take it from what we call a three-legged stool of the US, Euro area, and China. You're capturing most of, or more than half of final demand at that point. Truth is we cover most emerging markets and most developed markets. So we complement it with that fourth leg, but at least you capture the if you're looking at the consumption base of the world, those three would be the big consumers. Others would be treated as exports. So the fourth leg of that stool would be the exporters. So it would be a framework that integrates what is the growth pulse working on those three. What is the policy pulse? If policies leading to growth and ultimately to inflation, what are those things doing? What are the dynamics in those three in terms of excess slack, labor markets, those kind of things, if you're dealing with what we have right now as an inflation issue. So there's those elements of it. If you're dealing with inflation, we have about a prong approach to looking at it. We're not just monetary economists that will think everywhere and everything inflation's a monetary phenomenon. I fundamentally disagree with that. There's lots of other globalization factors, technology factors, there's other types of things. So having an ability to frame the issue is really our core competence. And there are some core frameworks internally, but then of course, as we get to an issue like a pandemic, being able to pull that team with that idea together of how you would frame a pandemic, what you would think of it. And one of the cores of us was to say, well, the pandemic's not truly a recession. When it occurred, it was more of a natural disaster. And so understanding how to frame it as a natural disaster and looking at earthquake effects and other types of things and other types of territories, and understanding what happens when you shut down a whole economy and then try to restart it back up, put a lot of fiscal stimulus on it. What does that mean for growth? What does it mean for inflation? Those kind of things. So don't look at it just in a simplistic manner, but from a framework perspective, get the right framework first, and then you'll probably get the investment strategy on the back end of it.
Okay, this is great, Philip. Let's put that in action.
All right.
A final question. I would like to know who are your favorite economists, who you like to read, who is a must-read economist. I know this is always a tricky question because nobody wants to leave someone out and make someone get offended. But who are your top five people?
Unfortunately, I mean, I don't want to. I don't want to offend almost anyone, but yeah, exactly. But actually, for me, the root of my analysis. So we have a wide team of different partners, and my partners will read various different people, either to get a sense of what the pulse of the market is doing, or more importantly, we'll read a lot of central banks to see where their tone is. We try to, rather than forecast or read central banks, we try to forecast where central banks will be. But the economists at the central banks will tell us how far they are from capitulating to where they need to be, and so where the opportunities are. So in many ways, it's a lot of working economists, functioning economists. Myself, particularly, I learned, and it's not an arrogance approach by any stretch, it's just I learned very early in my career that focusing on data and charts, I'm a huge chart hog. I built one of the most sophisticated charting platforms in the world to do this. Spent way too much money on it, too much effort. But looking at the raw data and letting it tell the story, and then going back and seeing what the commentary was good, because I found otherwise, especially as a young economist back 20 years ago, maybe I'm more rigid now, I found that other people's views would sort of skew my perceptions on things. So it was better better to come from a raw approach and then complement. And so I actually read very little, unfortunately, of other people's work until I get to the end goal, which gives me.
It's not the first time that I get the same answer. So, but
okay, all right, I thought okay. I don't want to sound arrogant on it. It's not that other people don't have stories. It's just that they have different approaches. And I like
it's
to
a
play
typical answer. I would say that myself, when I was doing research, I tended to do the same. So show me the data, show me the charts, and let me see the raw data, and I'll come to my conclusions. Okay, so Philip, let's put the framework in work, if you like. So how would you, let's begin, let's do some top-down approach and some past to present. So let's think, let me how would you summarize the global macro trends in the last 5 years? So the pre-pandemic versus the current economy, what has changed? What were the questions that you were doing 5 years ago, and what are the questions that you're doing now?
Perfect. I mean, first of all, I think that's a really good question, because I think most people have a real confusion of how the pre-pandemic is different from say post-pandemic, and actually what the pre-pandemic was. I think this is a good example of framework. People, I think, have the wrong framework of the 2010s. Right now they're using it as some sort of a base case scenario of where equilibrium is after the pandemic distortions unwind and what we're going back to. And I think that's the complete wrong premise to start with, because the 2010s really wasn't any way, shape, or form an equilibrium. It was an extreme outlying period, right? Mm-hmm. This was, a lot of the research I'd done early in my career was on housing bust and the fallout afterwards and what deleveraging cycles look like. And the US and Euro area kind of fell. Two biggest economies or biggest sources of final demand fell into that. Obviously, they went through the bust of the late 2000s. And had to go through an extensive adjustment process. And that really distorts it. Now, the difference there is they're world reserve currency, so they didn't get the same currency appreciation. But set that aside. The 2010s was a very abnormal period where you had extensive household sector deleveraging from both the US and Euro area households. You had banking system strains, which had to go through and fix their balance sheets. You had deleveraging pressures there too, which dampened growth throughout that process. You had tremendous slack left over in the Great Recession. So abnormal slack that took a long time to absorb because we were growing so slow. So people look at the 2010s and say, well, this must be some sense of base case of when the pandemic's over. But it really wasn't any way, shape, or form a base case scenario. It was an outlying period of really subdued growth and really subdued inflation. And in fact, actually, that's where this, for 10 years since the Great Recession, we've taken hard shots at secular stagnation. That was never a good narrative. It was the wrong framework. People had it completely wrong. Larry Summers finally capitulated on it. I've trashed him not trashed him, but I've been criticizing his work on it for a decade, and others. It was a deleveraging cycle. It was a very typical deleveraging cycle, but it was no way, shape, or form structurally broken. And so we actually ended that period in probably about 2017, before the pandemic. Just it was slow moving transition away from that deleveraging. The slack had been absorbed. Inflation was trending higher. It was way above 2% at that point, going into the pandemic, closer to 3%. We were shifting to what was probably more an equilibrium world. And now, during the pandemic, policymakers, of course, made that mistake. They overshot. They juiced it as if we were in secular stagnation, and we had to do what we did after the Great Recession.
So it's private deleveraging, because the public sector the debt in the global debt was going up. So probably we had this shift from private to public.
Yeah. Yes, there is. And what matters within an economy is there's two things when you're dealing with debt levels. Is you're dealing with what is the total debt to, first of all, you have to rebase it to something. So GDP is a good or incomes if it's a private sector, those kind of things. You're right. There was this massive transition. But the second thing you have to worry about when you're dealing with debt, because I do a lot about debt crisis events and European debt crisis. I've been a global strategist in the past. I've done all these things, but you have to look at which segment of the economy is at so-called breaking point, right? Have they gone through their debt threshold? So in 2006, 2008, obviously the US and peripheral Euro area had gone through that debt threshold. So they had gotten to an alarming level. Then we had to delever. And in part of that deleveraging, obviously the government sector took some of it. They took some of it during the financial system crisis, and they took more of it during the pandemic, where they transferred over massive amounts of wealth over. And the key is that although aggregate debt hasn't really fallen, household sector debt is delevered substantially. So it's much, much lower leverage in the household sector in both the US and Euro area, right? And so then you have to ask yourself, well, is the government sector at risk of a sovereign debt crisis? Is the US, for example, going to lose its world reserve currency because it's going to go through a debt crisis? Yields are going to spike, dollars going to collapse. And I would say that we're not there. So although we've had a transition, what we've done is we've taken away a choke point of a huge source of final demand. the household sector, and it's actually in really great shape, versus the government sector, which is on a terrible trend. And I worry about my kids on the trajectory that we're on fiscal spending, but we're not at a break point. We're not at a point where we're forced collapse or deleveraging of the government sector. And if we were, then the price of every asset in the world would change dramatically, obviously. So.
Okay, this was the pre-pandemic world, the leveraging, public debt, and how has that changed?
Yeah, so I think the key really here is, and a lot of people get stuck into what is the underlying growth trend, and we as economists or economists and certainly academia to sort of groups it into two camps, right? You have your cyclical growth dynamic, and then you have your potential growth. There's actually probably a more important one underneath the surface from when you're looking at trend growth, and it's what is the credit trend. So when you're leveraging up as an economy, as we did before the Great Recession, we and as we've done in recent years from the government sector transferring to the household sector. You end up growing a lot faster than potential, right? Or a lot faster than your long run equilibrium rate. But when you're deleveraging, as we saw in the 2010s, you're also subduing it. Maybe by the 2010s might have been over a percentage point of long run growth being more subdued. So and a dampening of inflation. So I would argue, look, there's been a lot of distortions. There was the housing crisis distortion, then there was a pandemic distortion, which was the other way. And we overshot in terms of growth and inflation. And now we're settling back into something that's more stable. Hopefully that we're not going to leverage or deleverage on either side. And it becomes a more stable growth rate, but it's a much faster growth rate, maybe a percentage point or more faster than we saw during the 2010s. It's also a higher inflation backdrop than we saw in the 2010s, because that wasn't an equilibrium by any stretch. It doesn't mean that the spike in inflation was sustainable. We were early on calling that spike during the 2020s because we'd already written the foundation that the inflation trend had changed. And so when you hit it with that much fiscal and that much stimulus into the system, you were going to get an inflationary, not a deflationary shock. But we were also called the peak in inflation, and we do expect it to come down. We just think it'll bottom out much higher than people think. So I think the new nominal growth rate of the world economy is faster, led mostly by the U.S. and Eurozone. The fact that they're in the household sectors, which account for the behemoth amount of, in the U.S.
This is interesting, Philip, because so basically, if I understand your base assumption on the economy, global economy looking forward, is that we are standing on a deleveraged economy. The private sector has deleveraged, so there is room to grow, a credit-led growth, but rates are 5%. So how do you mix that?
Yeah, so it doesn't
sorry, let me because we also are seeing, asset prices in the last 2 years have been shaky, to say the least. So how do you think in a credit growth on this shaky financial environment?
Okay, so what it gives you is it gives you a foundation, right? And then you got to overlay the cyclical. So the foundation of the world economy, and particularly the U.S., for example, when we go into the U.S., but particularly the U.S. or Eurozone, is that because the household sector is delevered, a lot of the demand actually this cycle, and which propelled the cycle, has been the fiscal transfers over. So it's been excess savings, and it's been that's fueled, and it's been wages. It actually hasn't been household sector credit that's fueled consumption. So it's not been a credit-driven cycle to start with. And because they've delevered, it means that every time interest rates go up, it's less of a bite to discretionary incomes. If you're an over-levered household sector, then interest rates go up, you get more of your discretionary income soaked up to service that debt. So what it's meant, and this has been really one of our frameworks and one of our core calls, is that the U.S. and world economy, Euro area and other parts, and because of those being so important, would be less interest rate sensitive. So if in the U.S. the household sector accounts for close to 70% of GDP, and doesn't feel the bite the same way as it would have in the 2000s when it was debt settled, right? Then it becomes less interest rate sensitive. It doesn't mean that there isn't some level of interest rates that does bite it, right? And that you won't ultimately go through recession. You will. In fact, actually, our view and we leaned heavily against the recession call last year in the U.S. or this year even in the U.S. And the difference between us and those who are calling for recessions for really the last 2 years isn't that we both think monetary policy or interest rates will eventually create recession. We both agree on that point. Where our difference is at what level of interest is going to break it. And I think it was a pretty clear message from the U.S. economy that this level is not breaking. So if you look at the interest rates, the economy is starting to stabilize. It went through a slowdown, and now you're starting to see the interest rate sensitive components of it start to pick up, including housing and those kind of things.
So the wealth effect transmission channel, it's less important than the credit, than the base point where you are standing in the credit level.
Yeah, I think I mean, credit's still going to matter, in terms of, or the interest rate cycle is really going to matter, and the credit channels are still going to drive the economy, especially when you're dealing with monetary policy that was deliberately trying to slow out inflation. So it's a credit channel element. We did have a big wealth pushover, and obviously in 2022 was an environment where, I mean, there was a massive recalibration in asset markets. So we ended up seeing after a huge wealth gains, we saw some wealth pullback.
Yeah.
Right. And the real mistake is that people bought too much into secular stagnation. Interest rates never go up. Even the Fed, we leaned heavily against it, but the Fed and ECB both believed that inflation was transitory, and then they had to capitulate to it. And then there was this whole thing about, well, 1% will be breaking the economy, 2% will be breaking, 3%. And so we ended up, as we normalized policy much more than people expected, we got a full recession scare. And so we had a terrible environment for the 60/40 portfolio because people just were not positioned, or totally wrong-sided on this environment. It was one of our biggest calls last year, was that the 60/40 would get hurt in that backdrop. But it really would, because we were trying to slow the inflationary dynamics and we had to capitulate to a new world. Now, a lot of that is in place, but I think there's still an element of bond yields still haven't hit that choke point. So there's still an echo effect, if you will, where bond yields could go higher and still have that.
You mentioned inflation. Let's deep dive on that.
Let's do it.
So what's your view on inflation? Not only on what are you looking at the future, but how do you explain? Let's go back to the acceleration process. How do you explain inflation? What happened? What do you think about the policy response? And of course, what are you looking forward?
I think the groundwork for inflation was just totally misread by almost everybody in the world. We were in 2016, 2017. It was such a transition.
I love that confidence.
Yeah. Well, the transition was in place before the pandemic, way before the pandemic, and it was just missed because people were so wedded to the fact that inflation could never rise and that it was always forever low. And so when you go back and you decompose what drives core inflation, if you will. I mean, headline has energy prices and those kind of things as well. But if you go back and you look at it, and you look at the environment that we came from, and then the transition to where we are, the big dampening forces, obviously, of inflation that kept us around 2% was that, after the Great Recession, we had this huge slack in the world economy that just took forever to absorb because we were growing so slow. So we had dampening pressures from both growth was muted, as we call it the mush environment, but it was weak growth, and a lot of slack, which was dampening inflation. So you had elements of that. You had monetary policy, which creates inflation, but it was broken, right? The transmission mechanisms were impaired at the time because nobody wanted to borrow any money at any cost of capital because they had to fix their balance sheets. So it's fine. Monetary and the banks were in trouble. And so you had those elements. Then you had globalization. We still had tailwinds of disinflation from globalization that was kicking on. And then we had technology revolution that was dampening price pressures. So there's about 8 factors that factor it, but those are the 4 probably big ones. But by 2017, 2018, we started to see that transition. The household sector had already, particularly in the US, had already tapered its deleveraging process. So it was no longer deleveraging. It wasn't leveraging, but it was no longer insensitive to the cost of capital, which made monetary policy was now functioning. The slack in the economy had been absorbed already. The economy was starting to grow at a little bit quicker pace, and hence why the Fed was normalizing going into the pandemic, they cut because of the trade war, I suppose, just before it. But you ended up seeing those kind of disinflationary dampening effects unwind. We had the trade war, obviously, which unwound some of the globalization. Now we have maybe de-risking of the US. So that trend is kind of behind. And some of the original technology, we may get into AI, but the original technology disinflation dampened. A lot of tech companies were starting to lift prices and have since post-pandemic. So all of the foundation had already shifted away from it. We saw about a 3% underlying inflation rate in the United States, for example. It wasn't 2% anymore, but people missed that. And then we overlaid it with a huge fiscal shot of stimulus. So now we had a demand shock on it. And we also have a supply shock with bottlenecks and stuff like that, right, with the pandemic. And so it was natural that you were going to get an inflation spike. It was a no-brainer for us, but at the time, people thought it was a deflationary shock. They were just wedded into the deflation world. They had to capitulate on it. But nonetheless, we had this demand shock. Now that's wearing its way through, and excess savings are still big and they're coming down. And so inflation pulse and some of the if you will, the supply bottlenecks are being resolved, and those kind of things too slowly, but they are being resolved, and it's coming down. But it doesn't mean we're heading to a 2% inflation world, if you will, in the US or Euro area. It means that we're going down to whatever was an underlying equilibrium, and probably with an upward bias, just because we've allowed the wage inflation to get out and other types of things, and there's some reinforcing logics to that became sticky again. And so, maybe it's 3.5 in the United States instead of 2. It doesn't mean we stay way up, but it does mean that we're...
It's interesting, Philip, that you almost did not mention the monetary policy in this history.
Well, I do think monetary policy has been very important. I think people give too much credit for it, in the sense that, but I think you have to give monetary policy. I mean, it is probably one of the most, early in my career, certainly one of the most important drivers, liquidity trends and monetary reflation leading to growth, leading to inflation. But we went through an episode, certainly last decade, so called the 2010s, where monetary policy was impotent. And I think central banks, I think that's the ego of the central banks maybe, but they were arrogant enough to believe that monetary policy was still everywhere and most important to inflation, and that they somehow, one, kept it under control, but secondly, they needed sort of subdued interest rates in order to create growth. And that's where the whole false so-called R-starred argument, or equilibrium policy rates, the Fed crushed its equilibrium sense of policy rates from 4% to 2.5% during last decade. Totally misread the situation. The point is nobody cared about monetary policy because nobody wanted to borrow.
Inflation was 2%, and it was good enough.
Exactly. But now monetary policy matters more because we're in a window right now where people have excess savings and they don't need to borrow as much. And so monetary policy has less of a bite on it. But that doesn't mean after the excess savings are worn off, then we get into more of a traditional economy where it is credit driven. Monetary policy has its traditional influence that it did maybe way before the Great Recession. And so I think monetary policy does play an important role in it. And if monetary policy wants to remain on the upper end restrictive level, then I think then it will dampen inflation. The flip side is that I view it as more of a cost of capital concept. And so right now you have a situation where monetary policy is, call it around equilibrium, maybe a little north of that somewhere. So it should have some dampening or some cooling effect, but you have an inverted yield curve. And a lot of the US and a lot of the world borrows at the long end, particularly in the US. And so the premature inversion of the yield curve, as people predicted a recession that was never coming, ended up subsidizing growth. So it's an aggregate cost of capital concept rather than just monetary policy. If the yield curve wasn't inverted, the Fed might not actually have to do much more, right? It may be dampening enough, right? Or if the yield curve is mildly positively sloped, if you will, like a traditional, so to speak, cycle. So
good. So let's spend a little more time in the USA, and then we'll move to Europe and to China. I want to hear your thoughts on China. Earlier this year, everybody was expecting a recession.
Yeah.
And well, there were the collapse of banks earlier this year, so it looked imminent, but it did not happen. So why do you think it did not happen? You already answered part of that, but why do you think it did not happen, and what's going to happen? What's your view on the next year on the economy?
So I think, first of all, I think people predicted a recession based on a series of old indicators, unfortunately, and sometimes that gets you to bitten. And they focus a lot on particularly manufacturing indicators. Sort of the ISM manufacturing became a go-to. Now, the ISM manufacturing is an indicator of accelerations and slowdowns in the economy. It's not actually a good recession indicator. It's had 12 signals below the 50 line, and in the since '83, and 8 of them have not called a recession. So it's actually a really crappy indicator, but we slow to let it die. And manufacturing is so small of the economy, and we had such distortions coming out of the pandemic, where during the pandemic everybody bought manufactured goods, and then they stopped it and they transitioned to services. So we had a unique distortion. But more broadly speaking, besides just the manufacturing, we have soft data, which we call the survey data. And when you're going through a slowdown period, and if you look back to the 1950s and you go through any, like after you come out of a recession, you go through an expansion, a quick expansion in the first year or so, and then you start to slow down. And usually that slowdown undershoots where the run rate would be of the cycle. But during that slowdown, the diffusion indexes, the survey-based data, ends up being quite weak. And it's really hard to disentangle, are we heading into a double dip recession, or are we just slowing down? Because all they are is diffusion indexes. They're measuring that the economy is slowing. And so we were slowing from a pandemic boom, and we had monetary tightening. So there was a good narrative around why this was recessionary, so to speak. But in those cases, we find it much more useful to look at the actual hard data of the economy. So actual economic activity, and was it validating? And what we found is an abnormal decoupling, where survey was particularly weak. One, because we were so high and the diffusion indexes were coming down, but so the press was everyone was uncertain. and then the press was so negative. And so you ended up with sentiment down. And actually, even in the sentiment gauges, if you look at how people perceive the economy or the future, they were quite negative on it. If you ask them how they perceive their exact current situation, they weren't so negative. How's your current income? How's those kind of things? And so there was this decoupling. And so I think people misgauged it that way. And I think what you did, you had this slowdown. Now, if the U.S. economy, as we're focused on, wasn't less interest rate sensitive than it was in the past, we probably would have hit a double dip recession by the time we hit 5% interest rate. So I think you had an anchoring of that, but really decomposing of it came down into what is the hard data doing. And we saw this year, for example, although people were very bearish on the U.S. consumer and housing employment trends and stuff like that, we saw sequential, consumption, although it's less interest rate sensitive. The part of it that is interest rate sensitive is housing, and we saw a sequential improvement in housing pretty much since January. So we're seeing that decoupling where it's just telling you the interest rates are elevated enough to cool things, maybe, but they're not recessionary levels yet. We haven't hit the breaking point. Now, that doesn't mean that if we either normalize interest rates further, where bond yields come up in a meaningful whoosh, that we won't end up there, right? We're at a late stage. It's a mature cycle. Cycles don't die on their own accord. They need the murder weapon, and the murder weapon in this case is tighter monetary conditions, and we just didn't have a sufficient enough weakening or level of interest rates.
And Philip, what are your latest readings? What's happening in Q3 in the economy? Is the economy growing?
Well, I think it's actually accelerating more than people think, but I don't think, that won't be, we're getting a bit of a pop up and there's big revisions up in terms of expectations, in terms of growth. So I think we're going to see that. Whether that's sustainable either, we're coming off of what you tend to do is you get these things when you go through those slowdown phases after, in this case was a boom, you get a slowdown, you always undershoot it, you bounce up a little bit to the trend, and you kind of flatten off. So that bounce up phase towards a higher but more sustained growth rate always looks like you're really accelerating quickly too. So I think it's all part of that wobble effect, if you will. We've written a lot in our work on it. And so I think we're going to settle into a decent trend in the end. There's some estimates out there that, we'll have like 5-6% growth now. I think reality is underlying growth is probably going to be more like 3%. It's not going to be,
So recession is not coming.
Yeah, recession's not coming until the cost of capital, and if there's not another black swan event, until the cost of capital goes higher. And so one of the risk factors that we look at in one of the calls that we had was that the 10-year Treasury yield would break out. I know everyone was saying it was a buy and it was going lower. And recently we had a punch to new highs. We took out the October highs in the 10-year. So long dated part of the curve went up. Now we've consolidated around that. The inflation's coming down, it's moderating, the Fed's looking to go to the sidelines. That could consolidate us for a while until people realize inflation will bottom out higher, and that growth is more resilient. But keep an eye on that element, because it's the cost of capital at the end of the day, and less to do with I know everyone's fixated on the Fed, but the long end of the curve matters, and arguably matters more. So that's kind of, that's the element. So the recession's not coming at this cost of capital. Doesn't mean a recession won't come. It will. We're late in the cycle. It's just a matter of when we get to that breaking point, and it's just not here yet. It won't, and not here in probably the next 12 months.
Okay. What about Europe? Europe is like this, slow-growing region. When you compare Europe to any other region, it's always like 1 or 2 months below. So, what's your view in Europe? Is Europe will Europe ever recover its growth?
Yeah, well, first of all, Europe has gone through a huge amount of challenges, obviously since the euro was formed, but then we went through the sovereign debt crisis, and households in the peripheries had to delever. So we've gone through a lot of that adjustment. It started that adjustment process later than the United States did, because it had the double dip recession last decade. It had the European debt crisis, so it had more challenges on it. But that process of deleveraging is followed the US with about a 3-4 year lag. So it has indeed delevered. The US was done by the end of last decade. It's pretty well done. It's in pretty good shape from a household's perspective now. Not, certain governments have excessive debt levels that the ECB is trying to make sure that doesn't turn into another sovereign issue. But certainly we have a similar foundation building that we would sort of call in the US. It didn't have the same fiscal transfer. The fiscal transfers in the US kind of dwarfed everybody, right? So we ended up with a much faster growth, and it was slower coming into the pandemic because it had ongoing lockdowns and didn't reopen as fast, right? And so we've had a more sluggish backdrop in that backdrop. So we didn't have this as big of a boom. That being said, we're more constructive on Europe because of the way it reopened. It reopened with a lag to the US, but it did have a reopening, and now it's slowing down. It's going through the same slowdown that the US went through last year and really kind of bottomed out at the beginning of this year. We think in the next few months, the euro area is probably towards the bottom, and we think the narrative is getting very negative on the euro area economy. But there isn't a case where monetary policy is really thrown it into a recessionary dynamics. If you look underneath the surface, you're seeing the exact same thing we saw with the United States, where the soft data is really what's really weak. But when you see the underlying sequential activity data, it's starting to improve gradually, but it is improving. So I think it's giving us some confidence that, look, if people might be whipsawed or wrong-footed again, like they were in the US, but within the euro area, where we see some stronger growth. It doesn't mean we'll have vibrant, booming growth or anything, but a pickup in growth where it adds to the global economy. But also what's important is it adds to their asset markets. So there's a decoupling there between what you think in the economy and the asset markets, because euro area earnings are outperforming the globe. So that is just be a reinforcing trend to it. So, and those assets are cheap. So I do think there's a bigger bang for the buck in the asset markets, even though the economy has kind of a gradual pickup. As long as it doesn't go to recession, it gradually picks up. And I do think we wrote a piece a week or two ago highlighting those divergences between the soft and the hard data, highlighting that it's really looks a lot like the United States did about 8 months ago. So don't get too bearish on euro. Would be the
okay. Okay, let's move to China. I'd like to hear your thoughts about China. I know you have a lot to say. This was supposed to be China's year, after pandemic last year. But China is somehow disappointing. It's sluggish consumer spending, shaky property markets, and of course, the risk in the USA. So what's your view in China? Is there a balance sheet crisis looming ahead? How would you summarize the China lookout?
I would say on China, we although we're probably more constructive now on in the markets. Coming into this year, we were much more subdued in our growth estimates for China, and the reason is that people were excited coming into 2023 was going to reopen. There's a lot of expectations that we get more stimulus in the mix than was ever really provided. And that we'd have sort of that booming scenario again in terms of China, like we saw in past either reopenings or acceleration phases. But the Chinese government has really taken quite a different tactic on this. They don't want to have the traditional export-led and investment-led sort of economic expansion. It also led to huge housing excesses that they're not keen on. So they took a much more, we want a consumption-led driven model and a more measured. They targeted it at 5% real growth, which I think ultimately it'll hit. And so it was kind of a more subdued growth picture than maybe people forecasted. We were kind of in that camp. I think China does have some challenges. We're seeing it in the consumer sector right now. I think that the consumer sector will come back, but we are seeing some softness in it. It was really, the household sector was scarred during the pandemic by repeated lockdowns and unclear policies, and it really caused a lot of trauma. But what you're seeing is in terms of consumer sector trends is you are seeing them get back out to service sector consumption and travel. You're not seeing them do the big ticket items, and so that's dampening the retail sales and things like that we all look at. So you are starting to see them come back into a consumption, but a very slow process. And I think it's just going to take time and that'll heal, but that will be a core to the call. That'll be a more constructive outlook than say a negative. Obviously, housing's a big issue there, and there are a lot of excesses and problems. Now, the difference between it, I think a lot of Westerners, we tend to overlay a US model on China in terms of housing. And there's some distinctive differences besides the fact that they control the banks there. But the Chinese authorities were proactive in bursting that bubble or trying to cool it rather than allowing it to turn into a full bubble that fell on its own weight. They really targeted it at that we don't want speculative demand. We want houses that you live in. Go after the property developers and force them to delever. And so they've sort of orchestrated this and managed it. It's a 2-year story. And I think it is a problem, and it's going to be a workout phase. And it's actually not going to be great for the developers for quite some time, because it was about a third of the market that was speculative demand, that wasn't houses to live in. And you're removing that demand. So you're now trying to grow into 2/3 of the market. Now there is some tailwinds or support because they still have about a decade of urbanization still to go. So some of that capacity will still get absorbed. So they have some windows of that to absorb, but it's going to be a great story for housing for a while. It's going to be a long sort of adjustment workout process. I think a lot of the recent negativity, though, on China has been associated with its exports, the idea of de-risking, and whether that's transitioning. However, a lot of the manufacturing or a lot of the export weakness is really symptomatic of the West, US and Euro area consumption demands more than any kind of de-risking, in the sense that we absorbed a lot of manufactured goods during the pandemic. And now we're switched over to services. Manufacturing has been soft everywhere, including China. And so China has had some dampening on the exports on it. Its imports still seem to be, oh, well, softened a bit, but it's oil imports and things like that. We should see a pickup as the economy improves. So the exports, I think, are symptomatic of that. It doesn't mean that we wouldn't see some of that due to sanctions, but most of that's in the tech sector and isolated components of it rather than broad-based. If you look at Chinese autos, for example, they've overtaken Germany as you know, in terms of their export share. They're going to overtake probably this year Japan. So it's not that they're not exporting. It's just the world consumes.
But Philip, for sure, the export growth is over. I mean, the export growth.
Absolutely. So I think in terms of your forecast, I mean, I wouldn't be too negative in terms of expecting a debt deleveraging sort of cycle like we saw in the United States and a deep recession, so to speak. But I wouldn't be too optimistic on what you think Chinese growth is going forward. Right now, the underlying trend of growth has been decelerating for a number of years. It's probably around 5% right now. Our forecast for a decade out is around 3%. So that's not bad, but it's not great, right? It's also not Japan, right? A lot of people tie up it as if it's Japan, and China has similar demographic issues, but Japan started from a very wealthy starting point with overconsumption, or over investment, all that kind of stuff, and had to go through a major transition. So we were talking about 0% nominal growth. In this case, we're talking about 3% real growth. So it's a slowing trend. Don't bank in that this is a booming source of growth, but it is a contributor to the globe, call it.
I see. So let's start adding all up. So what are how will you summarize the year ahead? So we're having a stronger USA than expected, a weaker China than expected, Europe slightly better. If you have to create a single, global win, this is a supportive compared to 1 year ahead. It's a supportive win. It's a win in the coming.
I think this year and transitioning as we go forward is kind of it's a constructive backdrop. People were too bearish on the U.S. They've had to capitulate away from that. I think people are now a bit bearish on Euro area and China, and they'll be capitulating towards a better growth. I want to put that in the context, though, that we're not starting a cycle. In fact, actually, we viewed, part of our frameworks was that we didn't view the pandemic as the beginning of a cycle, right? We viewed that as a temporary break in the existing cycle that had started really from the Great Recession, because it was more of a natural disaster shock. So we were already halfway through maturing cycle at that point. And I think, that's the dynamic that we're in. We're in a more mature cycle at this point. We don't have years of runway ahead of us. We also don't have a catalyst on the horizon at the moment that could burst that. But if we're talking about it, I think the growth is going to marginally be better. It's going to be, the US will be firm, which I think most people have shifted towards, but it'll maybe be firm, bring up bond yields in the process. The Euro area will shift up. China will shift up. The part that worries me or keeps me concerned about that, if you want to look at risk factors, is that when you're dealing with a later cycle dynamic, and no recession scenario, the issue is the cost of capital, because I think that's where the distortion was, right? Bond yields on a G7 level, anyway, certainly the U.S., were too low, banked on the fact that we were heading to an imminent recession. And so as you unwind that, there's a potential for another whoosh up. Now, we've seen a big move up since May, about 100 basis points on the 10-year Treasury, for example. And I think that becomes a risk, is that as people go away from a global recession view, bond yields come higher. Because keeping in mind the no recession view, particularly for the United States, which is front running this whole story, right, is problematic for inflation. Because if you look at the core inflation basket, a huge portion of it, there's goods inflation, which has come down because of base effects and unwinding and stuff, that's come down. So, and a lot of that disinflation's already been had. Then you've got housing, which come down. But a huge chunk of it, particularly for the PC basket that the Fed targets, is core services X housing. It's over half of that basket. And that is correlated with wages. So if you're not heading into recession, you're not getting wage weakness, you're not getting disinflation in that component, which means there's no hope in hell that you're getting to a 2% inflation target. It's just not going to happen without a recession. And so people have to come to grips with that by year end. And that might mean bond yields come higher. And so as it comes higher, that's where some risk factors come in. That's something we've always monitored. We've called it the weak links of the global economy. But those are things that you want to see, places that don't look like the US and Euro area, that will be the front edge of that. So for example, I was in Canada this week and talking about the Canadian housing bubble with the press up there and clients. But Australia, UK, New Zealand, most developed markets other than the US and Euro area have housing excesses that are sensitive to higher mortgage rates. So those would be front edge of mini blowups. We saw a regional banking system issue in the United States. That's part of the course of this. But now we'll start to see housing markets potentially blow up in different markets. And so that's something to keep an eye on. Also, there's a huge amount of money that flowed into private equity, private assets, right? As the cost of capital comes up, one, we don't need one to reach out there. And secondly, if everybody wanted out their money at some point in time because that cost of capital, they were really worried about recession or it was about to manifest, there may be a lot more financial contagion coming from that than we see from regional banking systems. So cost of capital has a way of eventually crushing things. And it's not, but the problem is I think people have been fixated on the strongest links of the world economy, such as the US and Euro area, because that's where consumption is. Start focusing on the weaker links out there and starting to see the blow-ups. And eventually they build enough contagion to take down the weakest links. So if the US household sector was to go into recession tomorrow, the world would be over. Fine. But there's lots that could happen in other places that could weaken.
What are those weak links in emerging markets? Probably.
Yeah, I mean, to a certain extent, but I think actually a lot of the developed, there are some emerging markets for sure with excesses and weak links. As cost of capital goes higher or bond yields go higher, they could become more exposed to that. Certainly the developed markets that have contagional loops into the developed markets. So the UK has a big housing excesses that if we see a deflation there, it's already got Brexit and other types of headwinds. We see that goes back into the Euro area. So it can indirectly cause financial strains into the Eurozone. Canada to some extent into the US. If it were to go down. So there's some developed markets that it can indirectly cause contagional aspects, because that's really what you want to see is you want to see these blowups and then you want to map them. Can they build, I call it critical contagion, but can you build enough contagion to take down where the demand sources of the world are? And I think you can, but certainly if private equity went, that's a core US issue. So if you're looking at US financial system strains, private equity, private debt is much bigger than regional banking system. The regional banks loan exposures and things like that were very small in comparison to what we saw the banking system exposure during, say 2006 to 2008. So that's why we didn't have the crisis build in it big enough. But it's systematic of what you see as bond yields go higher. So I think cost of capital is one of those things that you certainly want to keep an eye on. Then there's always geopolitics.
And Philip, geopolitics, that's leaving the economy side. So that's the global geopolitics worry you?
They do. They worried me a little bit more last year when we had the Russian-Ukraine war. I mean, we still do, but and the energy crisis associated with it. It was probably a testament to how durable that household sector was. It went through that energy crisis, and now it's fading. But yeah, if you end up with geopolitics spreading that kind of way, we're also coming into an election year next year for the U.S. Both sides of the aisle want to really take a hard anti-China approach. And so when you have two superpowers potentially sparring off against each other, if you think of that original analogy I gave of three legs of the global stool holding up, three legs holding up the global economy, and the US and Euro area were to impair each other in any way, shape, or form, that would be problematic. We're not there yet. It's premature to make that call, but certainly, geopolitics is something that we would watch very closely on that front. Either spreading wars or trade wars can be very disruptive.
Okay. One last question. We're already on time, but I would like if you could help me map this scenario into the asset prices. So I've seen your research a couple of days ago. So you were underweight in US, underweight in China. So what's your call there?
Yeah. So the key here for if you're taking an equity approach on asset markets, first and foremost, what I'm really talking about is a more resilient world economy. So maybe a stronger growth backdrop than people had factored in, but with a consequence of higher for longer interest rates. So the rate cuts that people expected coming in 2024 are really unrealistic, and so maybe higher bond yields. And so in that environment, you want to be in a place where you're positioned for I guess asset markets that can either absorb higher interest rates or higher for longer. So places where you get a big valuation support to start with, but then earnings to offset it. And so when you look at the US, it unfortunately falls into the wrong scenario of that. It's got an earnings cycle that's way ahead, and it's got stretched valuations, particularly with the high-flying growth stocks. Also an environment like that with more resilient growth and lower and higher interest rates is where you don't want growth stocks. So it's the flip opposite. These are longer duration assets. So even though they've had an AI theme and those kind of things, it's really a rotation, a broadening of the market play. So if you think about it, the US one is a bit weaker. Places like Euro area, tend to be appealing because they do have earnings that are outperforming the globe. So they have earnings support and a better valuation cushion. So that's a place where you can find some core support. In emerging markets, we have liked China up until very recently. We still like it in terms of a constructive, but we think that there's better value plays within emerging Asia in particular. So on the back of that China story, and it's really because the earnings beta, we think the semiconductor cycle is sort of at a low ebb right now. It's about to pick up. So other parts of emerging Asia outside of China are your better bang for your bucks, your Taiwans, your Koreas, those kind of things. And so so it's more of a emerging Asia, but with a focus from what was China to outside of China. On a rotation basis. And if you think about if there's any investors within the United States, there are places where you can get growth at a better value. So it's, instead of chasing the expensive growth stocks or the technology or the NASDAQ, top 7, you can do it through things like large cap banks, diversified banks. The regionals have problems and their earnings going down, but the large cap banks have solid earnings, solid fundamentals. So that's one area. Oil, we like that. We favor more the oil services than the producers at this point, just because the base effect of energy, it'll eventually work in its favor. But right now we think they got tough earnings comps, but the oil services will come through. And some of the industrial space, aerospace and defense, we've got huge backlog orders of aircraft. Travel's picked up. That's one of the tailwinds for Euro as well, is travel is booming for the first time in about 3 years. So we see some tailwinds from there. It's hard to see defense spending getting cut too much in this geopolitical world. So there are those that are more concerned than us, that are worried about defensives. Defensives are cheap at this point, but we would caution people, instead of staples and utilities, focus more on healthcare. We just think that the pandemic related distortions to sales is going to be unwound. Earnings will be stronger, but it's also less inversely correlated to higher bond yields. So if you want to be maybe more bearish, but you worry about bond yields having another shot higher, healthcare is your better defensive bet at this point.
Philip, this was great. I really appreciate your taking your time to speak with us and to share your view. We are already on time. This was great. We speak about a lot of things. We will be sharing this interview in our YouTube channel later today, in Spotify. So thanks everyone for joining today. Philip, I really, really appreciate you for joining us today.
Thank you for having me. It's been a pleasure.
Thank you. Thank you. Well, thanks everybody. Bye-bye.